Informed Choice Radio, episode 274, with Robert Carver, author of Smart Portfolios.
Live from Sundial House Studios, this is Informed Choice Radio. Want to make the most of your money and your life? You've come to the right place. Now, here's your host, Martin Bamford.
Hello and welcome to this episode of Informed Choice Radio. I'm Martin Bamford. Basketball player and coach John Wooden once said, "Whatever you do in life, surround yourself with smart people who will argue with you." Today on the show, I'm joined by Robert Carver, not for an argument, but to discuss his new book, Smart Portfolios, a practical guide to building and maintaining intelligent investment portfolios. Rob is an independent investor, trader and writer. He spent over a decade working in the City of London before retiring from the industry in 2013. He initially traded exotic derivative products for Barclays Investment Bank and then worked as a portfolio manager for AHL, one of the world's largest hedge funds, before, during and after the global financial meltdown of 2008. Rob was responsible for the creation of AHL's fundamental global macro strategy and then managed the fund's multi-billion-dollar fixed income portfolio. He now manages his own portfolio of equities, funds and futures using the methods you can find in his books. Rob's new book, Smart Portfolios, is about building and maintaining smart investment portfolios. At its heart are the three questions every investor needs to answer: what to invest in, how much to invest, and when to make changes to a portfolio. Rob addresses these three areas by providing a single integrated approach to portfolio management. He shows how to follow a step-by-step process to build a multi-asset investment portfolio and how to rebalance the portfolio efficiently. If you enjoy our conversation, and I hope you do, I do encourage you to get social with Rob on Twitter, where you can find him at InvestingIdiocy. Mention me too, please, at Martin Bamford. You can find the show notes for this conversation at icradio.co.uk/274. There's useful links, and you can also download our full episode transcript. That's all at icradio.co.uk/274. Here's my conversation with Robert Carver, author of Smart Portfolios, in episode 274 of Informed Choice Radio. Well, welcome back to Informed Choice Radio. I'm delighted today to welcome Robert Carver. Robert is author of a brilliant new book called Smart Portfolios, and he's also an independent investor, trader and writer. So Robert, welcome to the show.
Thank you, Martin. Thank you for inviting me on.
Well, could you start by telling our listeners a little bit about you and about your background, how it was you came to become what you are today?
Okay. So originally my academic background was as an economist. I got my first job in finance in the early 2000s, working as a trader in an investment bank. I very quickly realised that I wasn't really cut out for the cut and thrust of the trading floor. I spent a couple of years working in an economics think tank while doing my master's degree part-time. And then I got really lucky and got a job with a large hedge fund called AHL. And my first job there was to develop a new strategy that used economic data to make trading decisions. And then I got promoted to managing the entire fixed income portfolio. So that covers all products that are exposed to interest rate changes, including bonds and various kinds of fancy derivatives. I left AHL in 2013, and since then I've been a full-time investor and trader. Well, I found while I was working that I really had enough time to properly concentrate on my own portfolio. So once I had more time on my hands, I thought I'm trying to adapt what I've learned managing hedge funds to develop methods that would work in an environment that a smaller investor or retail investor faces. I thought the methods might be useful for other people, and looking around I couldn't really see any books available that covered the same ground, so I thought I'd give a go at writing. The first book came out a couple of years ago, and that was about using models to trade systematically. And the second book, which is much more about investment rather than trading, has just been published, as you said.
Fantastic. That's a really diverse background as well, with lots of sort of exposure to different elements of the investing world, from economics through to trading. So it gives a really good perspective. You mentioned there the difference between trading and investing. So could you just sort of explain that to our listeners a little bit? How would you define a trader versus an investor?
It's actually quite an unhelpful split, I think, because I guess you've one extreme, you've got people who trade very quickly. You've got these high frequency traders that we hear about in the news who might be holding positions only for a few microseconds. And then the other extreme, you might have someone who just buys a bunch of shares and then holds them for decades. But most people fall somewhere in the middle, and actually the kinds of techniques you need to use aren't that dissimilar between the two environments. So for me, it's a question of degree, really. That's why I don't really define myself as an investor or a trader, and I don't really think about different parts of my portfolio differently. I think it's actually quite an unhelpful distinction. I think the main reason why people use the term investor or trader is I think that traders have got a bit of a bad name, and if you tell someone that you're a day trader, they probably might have a low opinion of you, whereas investing is seen as a more respectable activity, I think.
I think that's fair to say, absolutely. Now, the title of your new book is Smart Portfolios. How would you define a smart portfolio? How does it differ from a foolish portfolio?
Well, if you look around at a lot of investing books, I think they tend to fall into two categories. A lot of books aimed, especially at the more retail end of the market, kind of say, well, investment's a very simple activity, and you just need to buy a few diversified funds, and that's all you need to do. And I think that's true to a degree, of course. And at the other end, you've got books that are full of theory and equations and all very highbrow. And I like to think that my book kind of falls somewhere in the middle. So smart is kind of street smart. So you kind of know that it knows about the theory, but applies it pragmatically, because the world is rarely so straightforward as textbooks suggest. But that doesn't mean that a very simplistic approach is necessarily right, although it can sometimes work. It's very easy to define what a foolish portfolio looks like, because I just need to look at the portfolio I had myself a few years ago when I'd finished working. So although I was employed as a professional portfolio manager, ironically, I didn't have almost any time to think about my own portfolio, and it was a complete mess.
Can you give us some insight into what that looked like?
Well, it was almost entirely in UK stocks, and I owned far too many. I think I had over 100 different positions, and some of those positions were very tiny, so just a fraction of a percent. In contrast, a smart portfolio has got lots of diversification across different asset classes and countries and industries, which is what the books on financial theory tell you that you should have. But it's achieved in a pragmatic way. So by buying the cheapest funds or stocks that give you the portfolio that you need. So you get something that's pretty close to the theoretical ideal, but is actually realistic and achievable.
Well, you've touched there on diversification, which is a topic we'll come on to talk about in just a moment, if that's okay. But what are some of the key questions that investors need to answer or ask and answer right now when they're making investment decisions?
Well, any investment decision can be reduced really quite simply to two factors. The benefits that you expect versus any costs that you have to pay. So you need to ask yourself questions like, well, what benefit am I going to get from this purchase or sale? And examples of benefits might be, well, if you're buying an actively managed fund, you think, well, how good is this fund manager? What kind of returns can I expect to get? If you're switching a stock in your portfolio, you have to say, well, why do I think this stock is better? What's it going to give me? Is it going to give me a high dividend yield? Do I expect to go more in value? And then a very important thing you need to do is ask yourself, how confident can I be about this benefit? How confident can I be in making my prediction? And most people are quite overconfident, actually, about how good they are at predicting the future. And most people should put quite a lot less weight on benefits and much more weight on costs. So you also need to be asking yourself questions like, well, how much is it going to cost me to do this? Not just in trading costs, but also in any extra management fees I have to pay. Are there any taxes that I'm going to incur? And there is one final question that I think is always good to ask, and that is, do I have to do this now? Can I wait? Can I delay this decision for a few days or a week or even longer? I mean, if I look at my own portfolio, there's too many times in the past when I've done some trading, and then a few weeks later I've realized that I've missed something or overlooked something or miscalculated and had to reverse it. And I would have been better off just waiting and then reassessing. So it's really about thinking about costs, thinking about benefits, and then just thinking again and thinking again, because most of us are in this game for the long haul, and we hope to be buying things that we'll be holding for years to come. And delaying things by a few days isn't going to make much difference.
No, absolutely. And cost you've mentioned there, and that's obviously a hot topic in the world of investing right now. How do you think investors can accurately calculate the true costs of their investments? Because there's lots of different costs associated with investing money. It's sometimes very difficult, isn't it, to understand the true cost that you're paying away?
Absolutely. I mean, I think in my book I identified something like 12 different categories of costs that you might have to think about. But just to keep things simple for today, I mean, the main two kinds of costs are trading costs and holding costs. So trading costs are costs you pay when you're buying or selling, and the most visible cost is the brokerage commission that you're paying. And for most small investors, that's probably going to be a flat fee. So if you find a really competitive broker, that might be £6 for a trade, or most brokers charge perhaps now about £10 a trade, and some are a bit more expensive than that. And if you're buying individual shares, you also have to pay stamp duty, which is normally 0.5% of the value of the trade. And if you're lucky enough to have investments which are outside of an ISA or a SIP, then you might also have to pay capital gains tax when you're selling. The other kind of cost you have to worry about if you're investing in funds is the holding cost. So this is a cost you've got to pay throughout the entire life of the investment, regardless of whether you're a buy and hold investor or you just hold it for a few days. And the most visible holding cost are the management fees, which are charged by fund managers. But there are other costs that are less obvious, and I call them invisible costs. Because fund managers don't usually buy and hold shares. They actively trade within their portfolios. And that's true both for active investors, investment managers, who you'd expect to be buying and selling a lot. But it's also true even for passive investors who are just tracking indexes, like the FTSE 100. Because as shares move in and out of indices, they need to be buying and selling. Now, the costs of this trading aren't covered by the management fee. It's not a kind of an inclusive deal, but you as an investor are still paying for those costs. And for passive tracking funds, these costs can be relatively low. So an all-in cost for management fee and trading costs could be as low as about 0.2% a year. For an active managed fund, it could be 1% or 2% or even higher. I mean, that doesn't sound very much, but paying just 1% more in costs would actually halve the value of your portfolio if you were investing from the age of about 20 to the age of about 80, which is a pretty typical lifespan. Now, these invisible trading costs are difficult to calculate, and certainly at the moment there's no obligation on fund managers to actually publicize them. Now, for a passive fund, it's relatively straightforward because you can just look at the benchmark index that the fund is supposed to be tracking, and the difference between what you're getting and what the benchmark is doing, that's going to be the total cost that you're paying. Now, with an active fund, it's more difficult because obviously the fund manager is trying to beat that benchmark, and you don't know whether any difference in the returns you're getting are down to their particular skill or luck or bad luck over that year, or whether it's because they're doing a lot of trading and generating a lot of trading costs. Now, there are moves at the moment to try and make the industry properly disclose all these kinds of costs of investment, but right now the best you can do is make an educated guess, and I give some figures in my book that you can use. So just to summarize, it's important to keep costs low, and part of that is trading when you only need to trade. But you mustn't forget about the holding costs. You must make sure that if you're going to be holding in investments that are costing you a lot in these management and invisible costs, you need to be confident that you're going to be compensated for that with better performance.
And of course, we've seen the regulator move from an annual management charge to a total expense ratio, and I think the term we're currently using is ongoing charging figure. Do you think there's still hidden costs then which aren't being fully reflected in that ongoing charging figure that investors should be aware of?
So it's my understanding that latest figure will include the commission that fund managers pay when they buy and sell. But actually, for fund managers, because they're obviously quite large investors, they get very competitive rates on their commission. And a much bigger cost when they're trading is the impact caused in the market from their trades, because their trades could be quite big. And that's actually even quite hard for the managers themselves to calculate. They actually need to do some work in measuring the market before they trade and after they trade, which is something that we did when I was working in a large hedge fund. So that's a cost that that the good fund managers will be measuring, but won't necessarily be disclosing even in that new headline cost figure, and the poorer managers may not even be measuring it. So, that's still, I think, an element of cost that's invisible, and particularly with active management, will be causing a drag on performance.
And you mentioned there the huge impact that even a slightly higher annual charge has, a 1% annual charge has on the value of a portfolio. So for an investor who's looking to be cost savvy and cut the costs within their portfolio, what's the best way to approach that? Is it through the rebalancing process or through the way they execute their trades? Is there something else, or is there another way of cutting costs?
So in terms of reducing your trading costs, I generally steer clear of military metaphors because I think they're overused in finance. Everyone seems to think that they're fighting a battle, but this one's worth using. So, during a war, generals have to worry about strategy, which I like to think of as, choosing your battles, which battles you're going to fight, but also tactics, how you're going to win those battles. So in terms of rebalancing, your strategy should be only to trade when you need to. And then when you've actually decided you want to trade, then your tactics come into play to try and keep those costs of trading as low as possible. And now there are a few different ways to reduce the amount of trading you need to do. But it's a really important subject, and actually devote something like 100 pages of my book to it. So we can't go into detail today. But so one important method to use is you should only trade if your portfolio weights are significantly out of line. So suppose that, for example, you've decided you want to put 10% of your portfolio in UK equities, then it's probably not going to be worth doing any buying or selling unless your exposure actually goes below 5% or above 15%. And by doing that, you'll get most of the benefits from retaining a diversified portfolio without having to pay lots of costs by doing lots of little trades. Now, if you've got a relatively large portfolio, or you're trading small firms or other liquid markets, then you also need to worry a bit more about how you actually execute orders, what your tactics are. And the key theme here is to be patient. So an impatient investor will go into the market and say, right, I want to sell £5,000 of shares and I want to do it now. And they're going to pay a cost for doing that, because as we've already talked about, there's an impact caused in the market whenever you trade. A better way of doing it is, rather than submitting what's called a market order, if you've got access to a good broker, you can actually specify the price you're prepared to pay and let the market come to you. And you should also try and split large orders up into smaller orders and execute them more gradually, even over several days. If you're a smaller investor, this isn't so important, because a single trade will generally be a cheaper way of doing it, because paying lots of little brokerage commissions for lots of little trades will dwarf any money that you can save from clever execution. So the general rule here is that everyone should take their time trading. Don't trade until you need to. And if you're trading in big size in a market that's quite small, you also need to then take your time actually executing your orders.
And within the book, you cover investing in collectives, things like ETFs, exchange-traded funds, but also investing through individual stocks. How can an investor decide which is the best suited route for their own portfolio?
Well, I've got a very short answer to this, which is unless your portfolio is relatively large, then you should probably stick to ETFs. Longer answer, we need to take a step back and actually think about how you construct a portfolio from first principles. And the very first thing you need to do is make sure that you're properly diversified. So you need to allocate some of your portfolio to equities, some to bonds, and perhaps some to alternative assets like gold. Then you need to look at the equities part of your portfolio and make sure that's properly diversified, so across developed markets, emerging markets, and then within different geographical regions and down to individual countries. And the same principles apply in bonds and other asset classes. At this point, you haven't actually bought any ETFs or shares. You've just got an imaginary chunk of your portfolio allocated to different areas. And it's at this point you then start thinking, well, how can I get exposure to these chunks of my portfolio? Now, I would argue that to be properly diversified in a given country, you need to own at least one stock in each industry sector. And depending on which classification scheme you use, there are about 10 or 11 sectors, top-level sectors. And the alternative is to actually just buy one thing, which is to buy an index tracking ETF. So to get access to the UK part of our portfolio, the UK equity part of our portfolio, the choice is going to be buying either one ETF that tracks something like the FTSE 100 or the FTSE All Share, or to buy 11 different shares. Now, the problem is that buying 11 different shares is going to be quite expensive if you're a relatively small investor. So if you've put £2,000 of your portfolio into the UK, if you're going to be paying, say, £10 a trade and the 0.5% in stamp duty that we talked about earlier, then altogether your bill for buying 11 stocks is going to come in at £120, which is quite a big chunk of your portfolio. It's 6% of your portfolio. If you buy just that one ETF, then that will just cost you the £10, which is less than 1/10 of the cost. Now there is a benefit from buying those individual stocks, because you can get a little bit more diversification than you can in the market tracker, and you can also try and select stocks that you think will do better than the overall market. But it's not going to be a benefit that will overcome that kind of massive extra cost. So you really need to be looking at a much larger portfolio before stocks start to look like a better bet than ETFs. So in my book I do the maths. I work out that if you're paying this £10 commission, then you can't really be thinking about buying individual stocks unless you're looking at investing £80,000 in the UK. And that's just in the UK. So obviously that's part of a much bigger portfolio. So you're looking at quite big numbers. And the other thing is, it's not really a binary choice. It's not really a question of saying, well, you have to own ETFs, you have to own stocks. And so in my own portfolio, actually, most of the time I'm owning ETFs. So all my bond allocations in ETFs, my allocation to US equities and European equities is all via ETFs. But in the UK, I prefer owning individual stocks. So I do both, and if your portfolio is a reasonable size, then that's a sensible approach as well.
So that total portfolio size, to have, say, £80,000 allocated in the UK for individual stocks, might be, say, £500,000 or something?
I mean, yeah, it depends. So, I mean, my own stock allocation in the UK is actually probably higher than my book suggests it should be, and that's just a reflection of the fact I'm still repairing the damage I did to myself a few years ago. I have 20% of my allocation in the UK, but in my book I actually recommend that you should have perhaps 4 or 5%. So that suggests that your total portfolio will be well over £1 million. So it is really for individual stock investment. Isn't really economic unless you're a relatively large investor, at least in my opinion.
And then sticking for the moment with the subject of diversification, when it comes to risk management, this is a really important concept. How much diversification would you say investors need? You've mentioned there, one company per sector per country, but what does that look like in a typical portfolio? Are we talking about 10 stocks or 100 stocks or 1,000 stocks? If a portfolio is large enough, how diverse do you need to become?
Well, you're right. So if you were to say, right, I want to own every country in the main MSCI global index, which is about 40 countries, and if you're going to buy 11 shares in each of those, so you're talking about a portfolio that's got several hundred stocks. So yes, if you're just buying stocks and not funds, then a properly diversified portfolio will have hundreds and hundreds of stocks in it. And then you need to add to that an allocation to other asset classes as well, because I don't believe that anyone should just be owning equities. But like I said, I mean, I've got a mixed portfolio. So a more realistic example is to say, well, let's say you're already properly diversified through ETFs, and you've already got the magic 11 stocks in a particular country. So the question you ask yourself is, what benefit do I get from going, say, from 11 stocks to 22 stocks, so buying another stock in each sector or beyond that? Now, the thing about diversification is the kind of more granular the level of your portfolio, the smaller the benefits are. And the benefit from owning, 2 UK house builders versus owning 1 UK house builder is very small. And you've got to weigh that up against the costs that you're going to be paying, because you're going to be paying another lump of commission. So instead of paying 11 lots of commission, you're going to be paying 22 lots of commission. And the number here is even bigger. So if I work out whether you should be owning 1 stock per sector or 2 stocks per sector, you're looking at an allocation in UK equities of £400,000.
Wow.
Which, and again, if you scale that up to the whole portfolio, it's going to be many, many millions of pounds. So, for the vast majority of people, I think one stock per industry sector is more than enough diversification.
I have to say, in my own experience, I see a lot of people get really carried away with diversification. I'd often review portfolios, and it has every flavour of the month fund or stock in there, pages and pages in the end, and you question why. And they're of course trying to reduce the risk, but in many cases they're not really gaining any benefit, are they, from that level of diversification?
Exactly. I mean, you've just described exactly what my portfolio looked like a few years ago. So, and it really is flavour of the month thing, because actually working in the financial markets, you hear. Obviously, I was never involved with anything like insider trading, but you're always aware of the news and what's going on, and there are ideas all around you, and it's very easy to just jump on every bandwagon that goes past, while forgetting the basic principle that diversification is great, but owning 10 UK retail stocks is in your portfolio and nothing else is not diversification at all. And buying another 10 UK retail stocks is not really going to help you. You need to take a step back and say, well, actually, I need to get my asset class allocation right, and I need to get my country allocation right. And only at that point should I be thinking about whether I need to own any UK retail stocks.
Now, you talk about in the book something called systematic forecasting algorithms. I need you to explain this to me, Robert, because I don't understand that. How are these used to adjust portfolio allocations?
Okay, so this is kind of in the optional extras part of my book, because the first few hundred pages of my book, I'm afraid it is quite a weighty book. I mostly say, well, you assume that you can't really predict the future, that it's very difficult to do that. And then I do take a step back and say, well, actually, in my career, I have used systematic ways to predict the future, and I think they seem to do better than most people in actually making forecasts. Let's take an example. There's plenty of evidence, academic research, and also performance by hedge funds that use this kind of strategy, that anything that's gone up in price recently will continue to do so. And you'll sometimes hear this called momentum or trend following. And that there are, just to be clear, there are lots of rules that I think are valid in predicting the markets. This just happens to be one that I personally reasonably familiar with, so I'll use it as an example. So if I look at the global equity indices, look something like MSCI World, which is an index of all the equities around the world, over the last 12 months, it's been a pretty good 12 months. They're up about 18%. And if I do the same and look at the bond market, look at a global bond index, that's actually down slightly. It's down about 0.5% or 1%, depending on which currency you look at. Now, a momentum rule would say, well, anything that's been going up, you should expect to go up more than anything that's been not going up as well or indeed falling. So you should put more of your portfolio than normal in equities and less of your portfolio in bonds. Now, a very important point is that doesn't mean you should sell all of your bonds and buy equities, just have a 100% equity portfolio, because these rules aren't perfect. They're not, crystal balls. They give you an indication of what might happen, but they still aren't 100% accurate. I don't believe there are any perfectly accurate ways of predicting the future. So in practice, if you start off with the classic portfolio that's 60% equities and 40% bonds, you might at this point shift that to 70% and 30%. And that means you'll, over the long run at least, you should get a slightly better performance than if you just stick to 60-40 all the time. But the important thing is, a really important word here is the word systematic. It's a system. You have to stick to it. You can't say, right, I'm going to use this rule today and then in a month's time switch to using a different rule, or indeed using no rules at all. So you do really need to have a lot of self-discipline to use these rules. And in fact, part of my portfolio is actually completely automated. A computer program does all the trading, and that's basically because I don't trust myself to do it. So if you're a whiz kid programmer and you can program your computer to do it, then that's great. If you've got the self-discipline to do it yourself, that's also good. But otherwise, it's probably better to be really cynical and say, well, I don't believe that even these rules can predict the market, and I'm just going to stick with my portfolio as it is.
And thinking about forecasting, thinking about the future in the current state of the global markets, we've got billions of pounds worth of quantitative easing, we've got trillions of dollars worth of it, although that's now being tapered away. How do you forecast? How do you think about the future with this sort of artificial market environment taking place?
I mean, it's interesting because I've been in the investing game for a reasonable amount of time, and the market is always unusual. There's always something unusual going on. I mean, it's probably hard to believe, but if you look at the bio picture on my website, I'm actually only 43. Everyone assumes I'm a lot older because I haven't kept much of my hair. But even over my lifetime, there's been a lot of very unusual times. There was the '87 stock market crash. There was Black Wednesday in 1992 when we crashed out of the European exchange rate mechanism. There was a crisis in Asia in '97. There was another crisis in Russia in 1998. There was the dot-com boom, the dot-com crash, and then, of course, then in 2008 we had the mother of all crashes. So I think it's very easy to look around and say, oh my goodness, the market environment now is so difficult and so unusual that it's much harder to predict than in the past. I'm not sure that's the case. I think we're all, you're generally living in a time that's different from other times. I don't think there's such a thing as a normal market environment. But having said that, a very sensible approach is to actually say, well, I'm not going to try and predict the future. I'm not going to try and do any forecasting. I'm just going to by putting diversification as your first principle in any investment decision you're making, you're basically saying, I don't know what's going to happen. I'm going to avoid exposing my portfolio to too much risk in any individual market. So rather than trying to predict what Janet Yellen's going to do with the Federal Reserve, I'm just going to put a certain amount of my portfolio in US bonds that, if she does something weird, will go down more than anything else perhaps, but I'm not going to try and predict that. I'm just going to try and keep that risk as small as possible while still getting the benefits of that. And the other approach is to use these systematic forecasting models, because many of them have been tested and all used over quite very long periods of time. So the momentum model I talked about earlier, that's been tested over data sets running back over 100 years or more. So you think times are unusual now, that covers 2 world wars and the Great Depression and all kinds of interesting times, and those models still carried on doing a reasonable job of giving you some indication of where the market went. So I think investors waste too much time trying to predict the future. There are very few people in the world that have shown that they can consistently predict market movements accurately. I mean, I certainly can't. My own experience is that the more time I spend thinking about my investments, the worse I end up doing. So, masterful inactivity and sticking to simple rules and principles certainly work for me.
Yeah, that's definitely the way to go. Robert, thank you so much for joining us today on Informed Choice Radio. Before we finish up, before you go, where can our listeners find out more about you, and where can they buy a copy of your book? So if you go to my website, which is systematicmoney.org, there's links there to my blog and info about me, and also a link to the publisher's webpage where you can actually buy the book. And I'm also one of these people who wastes far too much time on Twitter. So if you're interested in reading my tweets, my handle is at Investing Idiocy. It's a great Twitter name. Fantastic. Robert, thanks for your time. I'll make sure I put links to those in the show notes for this episode too. That was great. Thank you. Thank you very much, Martin. A big thank you to Rob for joining me on the podcast today. If you want to learn more about constructing and maintaining a smart investment portfolio, do check out Rob's new book. It's called Smart Portfolios, a practical guide to building and maintaining intelligent investment portfolios. I'll put a link in the show notes for this episode at icradio.co.uk/274. What did you think about our conversation? Please let me know on Twitter at Martin Bamford, or you can use the comment section in the show notes for this episode. That's icradio.co.uk/274. That's also where you can find useful links and the full transcript for this episode. Don't forget to connect with Rob on Twitter. You can find him there at Investing Idiocy. Saying thank you to our guests on Twitter is a really easy way to support Informed Choice Radio as we continue to grow, and it helps us to reach out and find more brilliant people like Rob that we can interview, and that helps to bring you closer to achieving your own goals in life. And before you go, please do take a moment to share this podcast episode with a friend on Twitter, Facebook, LinkedIn, anywhere else you hang out online. Each time you share an episode on social media, it helps to boost us up the podcasting charts, and that means we can reach even more new listeners. And if you've not done so before, please do leave us a quick review on iTunes, or if you listen in Overcast, press the star button next to this episode. Thank you for listening to this episode, and thank you for your continued support of this podcast. Until next time, I'm Martin Bamford, and this is Informed Choice Radio. And remember, when it comes to your money, the more you know, the faster it can grow.